Hello, everyone, and thank you for attending Isdiner and Company's webinar on year-end tax planning. We have some great speakers here today, and we are excited to share some tax planning considerations as we close out the year. One housekeeping item before we begin. Please enter all of your questions that you may have in the Q&A section, and we will address them at the end if we have time. It is important that you leave your name and email with your questions so that we're able to respond afterwards if needed. With that, let's get started. We're going to start today talking about some of the tax bracket limitation changes that are going to take place in 2023. Next slide, please. So for gift taxes, we have that the annual exclusion, that for just an overall reminder for people, the annual exclusion is the amount that you're able to give without having to incur a tax filing for gift taxes. If you give up to $16,000 by the end of the year to any one person, and it's per donor or per donee. If you're married, you basically can double that in order to make a gift to someone else. And then that would be the limit without having to file anything, any gift tax filings. That limit is now going up to $17,000 in 2023. Additionally, the lifetime exclusion, which is more with regard to larger gifts overall when you do file or for your estate tax purposes, that this lifetime exclusion adjusts every year, and it's going up by another $860,000 to a total of $12,920,000 in 2023. So a very sizable hike overall. The reason for all these hikes that we're talking about is because a lot of these brackets are indexed for inflation. As we all know, inflation has been impacting everyone, and the tax brackets are set up in such a way to accommodate some of these changes. The income tax brackets, which are the ones that people probably care a little bit more for day to day, the brackets themselves did not change, but again, due to inflation, the ranges ended up changing. And overall, 2023 saw a 7% increase from 2022, which is a much more sizable increase than we've seen in recent years. Next slide, please. So for the lowest bracket is a 10%, and that's for incomes of 11,000 or less. Married would be 22,000. So these are the increased brackets. So all these are now up significantly, like I said, over about 7%. These basically speak for themselves. But overall, what does this mean for taxpayers? I mean, again, it means that even though people may have seen significant increases in income as a result of inflation because of the adjustment in the brackets, this does mean that the tax hit for you is not necessarily going to be felt as significantly. As inflation does increase, however, the brackets are locked in place, so there will be some additional hardships as the Fed does look to continue raising interest rates to attempt to combat inflation. Next slide, please. For Social Security, the cap on earned income was now increased to $160,000, up from $200, which was up from $147,000. So a very sizable hike. Again, compared to prior years, this one was more like 9%. Not everything is ultimately indexed solely to inflation, but overall is a main driver. Next slide, please. Next slide, please. And lastly, for the alternative minimum taxes, most taxpayers don't qualify for this anymore as a result of the Tax Cuts and Jobs Act, which changed things so that taxpayers who earn less than $1 million may not be subject to alternative minimum tax unless they have certain things that would create adjustments for this purpose. The one that we see more commonly has to do with incentive stock option exercises. Some people may or may not be aware of this, but when you exercise ISOs, as they're abbreviated, that will actually create that spread for the exercise will actually create an AMT adjustment and often cause a situation where a taxpayer may owe this alternative minimum tax. So even though the exemptions, which we have listed here, having gone from $75,000 to $81,300 in 2022 to 2023, and the exemption itself begins phasing out around $578,000. If your single, and if you're married filing jointly, it's 126,500 with a phase out over $1 million. Again, all of these things are indexed for inflation, and it's just something to keep in mind as we move forward. And with that, we're going to start talking about some of our tax planning opportunities and retirement contributions, and I'm going to hand it off to Mitch.
Sorry about that. Good morning. So I'm Mitch Gerstein, and I am going to be discussing one of my favorite areas, and that is retirement plans. One way to reduce your current 2022 taxable income is to max out your retirement contributions. In some cases, like with an employee 401k, it must happen before the end of the year. With other retirement plans, contributions can be funded in 2023. However, you are able to deduct those contributions against your 2022 taxable income. So what are some of the types of retirement plans? First, already mentioned, is the 401k employee plan. It's the most common way for an employee to contribute to a retirement plan. It's set up as an employer-sponsored plan. However, it's intended solely for an employee to contribute through payroll, thus reducing an employee's taxable income. A 401k employee plan also allows for Roth IRA contributions, again through payroll. Doesn't reduce your employee's taxable income. You're using after-tax dollars and grows tax-free if you meet the Roth IRA rules. Next up is the 401k employer plan that piggybacks onto the 401k employee plan, as the employer contributes either a percentage or a dollar amount based on an employee's wages, and it reduces the employer's taxable income. Moving on to smaller types of plans, a simplified employee pension plan, that's a SEP for the lovers of acronyms. It's meant for self-employed individuals, small business owners, and their employees. It's funded with pre-tax dollars and grows tax deferred. Finally, individual retirement account, IRAs. There are traditional IRAs and Roth IRAs. Both are generally utilized when an employer doesn't offer a retirement plan. Traditional IRA contributions reduce taxable income and earnings grow tax deferred. Roth IRAs are funded with after-tax dollars, so therefore there's no tax deduction, and earnings grow tax-free as long as specific rules are adhered to. Okay, sorry about that. So let's do a deeper dive with 401k plans. So there's the 401k plans where it's the employee's contributions. The 2022 maximum contribution to a 401k is $20,500. For 2023 plans, that will go up by another $2,000 to $22,500. Plus, if you're 50 and older, there's an additional catch up of $6,500 for a total contribution of $27,000. And that also will increase to $7,500. So therefore, it'll go from $27,000 for 2022 to $30,000 combined in 2023. The contributions are pre-tax dollars, as I spoke of before. And with the employee contributions, you only have until the end of the year through your last paycheck. If there are employer contributions, which we'll speak to about in a moment, they don't count towards the $20,500 or the $20,000 in total contributions for employees. The employer 401k plan is solely employer contributions. The 2022 maximum contribution to a 401k employer plan is $40,500. based on annual compensation limits of top limit of 305,000 hours of wages times 20% is $61,000. So that's how do we get to 61,000? That's the employee portion, which was the $20,500 that we spoke about, plus the employer portion, which is the $40,500. That's 61,000. And then on top of that is the over age 50, which allows you to put in 2020, 2022, an additional $7,000. Another type of employer plan is the simplified employee pension plan. They are for self-employed, as I spoke about before, small business. They are based on 25% of your annual compensation, and the same caps apply, the $61,000. Next is the individual retirement account, IRAs. There are traditional IRAs and Roth IRAs. Both are generally utilized when an employer doesn't offer, as I spoke before, doesn't offer a company plan. Traditional IRAs contribute up to $6,000 in pre-tax dollars. It reduces your 2022 individual taxable income. A Roth IRA is also up to $6,000, but it's using post-tax dollars and doesn't reduce your 2022 taxable income. But the income earnings will be tax-free if you follow the Roth IRA rules. And then we mentioned also earlier about the catch-up for over 50. Limitations, there are some limitations on deductible IRAs and Roth IRAs based on your income level, and if you're already actively participating in an employer retirement plan. You also have a few extra months to contribute to an IRA for 2022. You have until April 18th, 2023. So here's some final thoughts on retirement plans. Now is a good time to evaluate the different types of plans, especially deferred compensation plans, which are specifically, and I covered these I just didn't call them specifically, the 401k salary deferral only, where the company doesn't offer an employer plan, but they allow the employees to contribute from their wages. 401k safe harbor is when there is an employer plan and there's a minimum contribution that is either a percentage or dollar amount based on the employee's wages. And then there's the profit sharing plan, which is allowing you to contribute the higher amount, going from the $20,500 up to the $40,500, which is then allows you to get a combined before the catch up of $61,000 in 2022. There's also a deferred comp plan for cash balance plan, which is more based on a defined benefit based on your ages. The older you are, the closer you get to retirement, the more money you can contribute. If you don't have these retirement plans set up for 2022, now's a great time to consider them, have them implemented for 2023. So now we're going to move on to cryptocurrency, and I want to introduce Carrie Goodman.
Cryptocurrency. What is taxable in virtual or cryptocurrency? Will you owe tax on cryptocurrency? If you were involved in a transaction involving virtual currency, also known as cryptocurrency, the answer could be yes. More and more people are entering into the investing side of virtual currency. Simply buying crypto or owning and holding crypto is not taxable. However, selling, trading, swapping, and even using virtual currency to purchase an item are all examples of potentially taxable events. Let's start by briefly discussing specifically what is taxable. You may receive crypto as income. This is taxable, similar to other income you receive. If you are compensated with crypto, you may receive a W-2 or a 1099 or no form at all. No matter the form or lack of form received, you are responsible for reporting this compensation on your return and will be taxed on the income. If you are involved in mining crypto, either as a job or as a hobby, this income is taxable. And it looks like this can be darn profitable if you are successful at it. I'm not sure how long it takes to add a block to the blockchain, but if you do, you receive 6.25 Bitcoins. And this was recently valued at a bit over $100,000. If you receive crypto as a reward or an airdrop, this is taxable income. Rewards can be received for holding your crypto for a specified period of time. This is also called staking. And an airdrop is a free distribution of tokens to numerous wallets to promote a company. Think free toaster or a gift card from your bank for banking there. Some crypto platforms give you interest for having your account with them. This is taxable income to you. You may also receive capital gains or losses from transactions involving virtual currency. You will owe tax on gains from selling, trading, or swapping your crypto, similar to traditional securities. If your swap of Ethereum to Bitcoin creates a gain, then you will owe tax on this gain. Maybe surprisingly, you could owe tax when paying for goods or services with crypto. This happens if the value of the good or service is greater than the value of your crypto when you originally received it. An important note regarding crypto capital transactions is that any losses incurred can be used to offset other capital gains. Next slide, please. Keeping on that note, virtual currency can help reduce your taxes too. Donating virtual currency follows the similar rules to donating stock and can have a major impact on your tax bill, depending on how much you're willing and able to donate. Again, you can use losses incurred in trading crypto to reduce capital gains. This might be very important information if you held an account with FTX or BlockFi, who both recently went belly up. Also to note, wash sale rules do not apply to virtual currency trading. This means you can harvest losses even if they were due to sales within 30 days of purchase. An important note regarding capital transactions is that you will pay less tax on trades of crypto that have been held long-term. Next slide, please. Now let's discuss the forms you may receive and should be on the lookout for this winter. You'll want these for tax preparation. If you were compensated with crypto, you may receive a W-2 or a 1099. These will be reported either as salary, business income, or other income as is appropriate. If you received crypto as a reward or airdrop, you should receive a 1099 MISC for miscellaneous. Exchanges that currently do send 1099s include Coinbase, Celsius, Gemini Earn, Bitstamp Earn, eToro, Binance US, Crypto.com, and Kraken. If you earned interest over $10, you should receive a 1099 INT, which stands for interest. If you sold or traded crypto, look to receive a 1099-B. Although this is not required by the IRS until tax year 2023, a few exchanges do currently provide it, like Robinhood and Cash App. While most crypto companies have switched from giving a 1099-K to giving the more appropriate 1099 miscellaneous or 1099-B, it is possible you will receive a 1099-K. This will show the cumulative amount of crypto you traded during the year. Please note, this does not show the amount of taxable gain you have. You will need the cost bases of your trades to compute the gains. Again, beginning tax year 2023, Crypto companies and exchanges will be required to send 1099 forms to clients. And there is a 1099 DA, standing for digital assets, supposedly in the works at the IRS, which may show up in 2024. Lastly, and very importantly, if you don't receive any of the above forms, you are still responsible for reporting your income and capital gains on your tax return. Next slide, please. Other information and resources for you to consider. If you don't have a platform keeping track of the cost bases of your crypto, you will want to keep records of this information. This is how we calculate your taxable gain or loss. Some other basics about taxation in the crypto world. Cryptocurrency is treated by the IRS as property, and so transactions using crypto are taxed like transactions involving property or assets. In case you're wondering, NFTs, or non-fungible tokens, are considered another form of cryptocurrency. So the same rules apply to transactions involving NFTs. I mentioned it earlier, but it bears repeating that simply buying and holding virtual currency is not a taxable event. Next slide, please. Here are some links and additional resources as well regarding crypto and taxes. And now Rebecca Norris will talk about charitable tax planning, estate planning, and gifting ideas.
Thank you, Carrie. So I'm Rebecca, and I am going to talk about just some charitable tax planning ideas. It's the end of the year. You've got 2 weeks left to touch up any charitable planning for the end of the year. It's also time to start thinking about your 2023 charitable tax planning. So this is a good time for us to be talking about this. And most of you, I'm sure, are familiar with the basic tax implications of charitable donations. You give money to charity, you get a deduction. What could be simpler? It would be really simple if you always got $1 of deduction for every dollar that you gave to charity. Unfortunately, as we know, taxes are never that simple. There are limitations placed on how much you can deduct each year for your charitable donations. There's no limit on how much you can give to charity. There's just a limit on how much you can deduct each year. That limit is based on your adjusted gross income, or your AGI. You'll hear it abbreviated. Basically, all your AGI, or your adjusted gross income, is that's all of your income from all your sources, whether it's wages or interest or real estate or whatever. It's all your income before your deductions. There are percentage limitations, percentages of your AGI that you can deduct. That's the ceiling of how much you can deduct each year. It's based on, the percentage is based on or determined by what type of asset you're donating. Are you donating cash? Are you donating appreciated stock or something else? And what kind of organization that you're donating to? Is it a public charity? Is it a private foundation? So for example, if you give $60,000, or if you give $100,000 to the Red Cross in cash, the AGI limit on cash donations to public charity is 60%. If your AGI is 100,000 and you give 100,000, you could only deduct 60,000 of that for the year. The rest would carry over to the next year. So just something to keep in mind. This is going to be kind of a high level presentation, just going over various planning ideas. We're not going to touch on every possible scenario out there. And one last tip before I go on. Whatever you do, you want to pay really close attention to the substantiation rules, which means you have to get those acknowledgement letters from the charities that you donate to. You want to make sure you keep up with those. They have to have specific wording on them. You've got to prove that you had that acknowledgement letter from the charity by the time you filed your tax return. You don't want to wait until you're audited by the IRS and go back and get it because they can disallow your deduction. So just keep that in mind. One of the simplest, probably the very simplest planning concept we're going to talk about is this concept of bunching. And what is bunching? It means exactly what it sounds like. It means you take the charitable contributions that you were planning on making over the next 2 or 3 or however many years and bunch them together all in this year. That's all that means. Why would you want to do that? Why would that be beneficial? Bunching can be very beneficial to really one specific group of people. That's people that are not able to itemize their deductions. The IRS gives you a standard, kind of a default, a standard deduction amount. It changes each year. You're allowed to take that against your income, or you can itemize your deductions. There's the various categories: mortgage interest, charitable deductions, medical expenses. If you can get deductions in all those categories to add up and beat that standard deduction, you can take that higher amount. That's called itemizing your deductions. If you don't have enough deductions, you just take the standard deduction. Sometimes people that don't have enough deductions to itemize, if they'll accelerate and do several years worth of charitable donations in 1 year, that helps them beat that standard deduction and get them more benefit. So just something to keep in mind. Next slide, please. So I'm going to switch gears and talk for a minute about donor advised funds. These are a really popular charitable planning vehicle. What is a donor advised fund? It's just an account or a fund. It's held by a sponsoring organization, which itself is going to be a nonprofit. They're going to hold and manage those assets that you donate for you until you're ready to distribute them to a charity, and that you can decide to donate those to the charity, in subsequent years. You can fund the account this year and wait a couple of years and give part of it away to one charity this year and another charity the next year, but you get the benefit, you get the charitable deduction in the year that you donate to that account. It's easy to find these sponsoring organizations that provide donor advised funds. There are community foundations, like the Philadelphia Foundation is a big one, and the Jewish Federation does donor advised funds. Places like Vanguard, Fidelity, Schwab. It's easy to find a place if you want to set up a donor advised fund. There's a lot of options out there. Your money that your assets that you contribute, they grow tax-free. You can put in the same kind of assets that you would put for any other nonprofit. You can put in cash, appreciated stock, other assets. I think sometimes they take real estate, cryptocurrency, partnership interest, all kinds of things. The AGI limits are the same as for any other public charity. There's a 60% of AGI limit for cash, 30% for appreciated stock. So the same kind of limits. There's a very minimal cost to these. There is going to be an investment management fee. But other than that, there's really no record keeping on your part. Everything's done at the sponsoring organizations level. You don't have to file a tax return for these. They're very simple. That's why they're so popular. You can fund a donor advised fund right now while you're alive. You can fund it through your will. You can make it the beneficiary of a retirement plan, a life insurance policy, charitable trust. There's lots of options to get money into these. One thing people like about these, they provide a lot of privacy options. You can usually give money out of your fund anonymously to the charities that you want to support. Some people really like that ability. The downsides are really, there's not a lot of downsides. There is a little bit of loss of control over your assets, because once you give to a donor advised fund, you don't own those assets anymore. It's exactly what it sounds like. It's a donor advised fund. So you're advising the fund or the fund holder how to donate these assets to charity. Technically, legally, I think they can, if you say, I want to give X amount of money to this charity, they're allowed to say no. I don't think they ever do that. They want to keep you happy and keep you investing more money with them. But you do have a little bit of loss of control that some people choose to do, like a private foundation instead of a donor advised fund, which we'll talk about in a minute, just because they want to keep the control over their assets. Let's see, let's move on to the next slide. All right, I'm going to switch gears again and talk about a couple of other options. If you're charitably inclined, a lot of people like to donate money out of their IRAs. So Mitch just talked about IRAs a few minutes ago. These are your individual retirement accounts. And what I'm really talking about is donating from a traditional IRA, not a Roth. When you turn the magic age where you have to start taking your required minimum distributions out of your IRA, right now that's 72, you have to, take out a set amount each year, and that amount's going to be taxable to you if you're taking it from a traditional IRA. But the IRS has a rule: you can give up to $100,000 directly out of that RMD to charity. The custodian of the IRA has to write the check themselves. It can't touch your pocket and then you write the check. It has to go directly from the trustee to the nonprofit. But if you do that, you can exclude up to $100,000 from your taxes. You're not getting a charitable donation from it. You're actually just excluding the income from your return. Since it's not a deduction, you don't have to worry about the AGI limits. 100% of that 100,000 or however much you give is just excluded from your income like it never existed. So it can be a real big benefit. There's really no downside to doing this. Depending on your personal tax circumstances, some years there may not be that much benefit. If you're not bumping up against those AGI limits, it may not make any difference whether you take the whole RMD into your income and then write a check yourself, or if you have the trustee do it and exclude it. But if you're ever on the fence, should I do this? Is it beneficial? I would say just do it, because there's never really a big downside to doing this. And this $100,000 exclusion rule is per spouse. So if you're married and your spouse is also over the age where you take your RMDs, you can each give $100,000 out of your RMD and exclude $200,000 out of your income. So that can be a big benefit. You just have to keep in mind, if you're taking advantage of this rule, those donations have to go to a public charity. They cannot go to a donor advised fund, the thing I was just talking about. They can't go to a private foundation, which is the thing I'm about to talk about. Has to go to a public charity. So just keep that in mind. If you have other retirement plans, which is again what Mitch was talking about earlier, and usually it's going to be like a 401k or a 403b or whatever. If you want to get money out of those into or use those assets to fund your charitable endeavors, the best way to do that is to leave the assets out of your retirement plan to a charity upon your death. So in other words, name a nonprofit as the beneficiary of your retirement plan. That's one of the most efficient planning strategies. A lot of planners recommend this because it minimizes both income taxes to your heirs and it minimizes your estate taxes. So you kind of get double benefit there. If you pass away and your kids, your heirs, inherit non-Roth retirement plans from you, they're actually taxed on the distributions when they take money out of those plans, and they're taxed on it as ordinary income. So instead, if you name a charity as the beneficiary, neither you nor your heirs nor your estate pay any income tax on the distributions. The charity is not going to pay income tax because it's a nonprofit. They don't pay taxes. Your estate, you get a charitable deduction, so you don't have any estate taxes. You save on Pennsylvania inheritance tax. So it can be a really good deal to do this. A lot of people take advantage of this. It's very simple to name a nonprofit as a beneficiary. You just name them on the designated beneficiary form with your plan custodian. You can even name a donor advised fund as the beneficiary. I think I mentioned that on the previous slide. That's a good way to leave a charitable legacy for yourself. So something to consider. Next slide, please. Okay, so I'm going to switch gears again and talk about private foundations. Private foundations, just like with a donor advised fund, you get a deduction, a tax deduction on your taxes when you contribute money into a private foundation. You get it in the year that you make the contribution to the foundation, not the year that the foundation pays out money or grants money to the charities that you want to support. The money inside of these also grows tax-free. And I think I mentioned before, you have more control over the assets inside of a private foundation. You have total control over the investments, investment decisions, the distributions where you're going to give the money to. You can also, there's a little bit more flexibility of what you can do with the money in here as opposed to a donor advised fund. Donor advised funds have to give money to 501c3 charities. A private foundation can do other things, a few other things like funding scholarship programs or charitable programs that are undertaken by individuals that are not 501c3s. So there's just a little bit more flexibility with what you can do with your dollars in here. On the downside, these are a lot more of a hassle. There's a lot more, it's almost like trying to run a business, especially if you have a big private foundation. You have to make sure there's a minimum amount you have to donate each year. You can't just wait and donate whenever you feel like it with a donor advised fund. The income that earns inside of here, it can be subject to excise tax. You have to worry about paying taxes. You can even have to pay estimated taxes. There's higher administrative costs. You have to hire an attorney to set this up. You have to hire an accountant or CPA to file tax returns. There's just a lot more work that goes into these. Let's go on to the next slide. So if you're trying to choose between putting money into a private foundation or setting up a donor advised fund, there's a lot of considerations to look at. But a couple of key things. The account the minimum amount to establish these is usually a lot lower with a donor advised fund. It's going to depend the sponsoring organization, whether you go to Vanguard or Schwab or whatever, they're going to have different minimums that you want to look at, but they're usually not going to be that high. It may be like 5,000 or 25,000 or whatever. But usually at that level, if that's the level you're wanting to fund something, you'd want to stick with a donor advised fund. It's usually not worth it to mess with a private foundation until you have a lot higher, hundreds of thousands of dollars, say, just because there is more cost and more work. The startup costs and startup time are much more minimal with a donor advised fund. If any of you are interested in setting up a donor advised fund and have not done so yet, you probably can do it before the end of the year. It's quick to do, easy. You just write a check, basically. Setting up a private foundation is a much more involved process. It's like setting up a new business. You have to have an attorney. You have to set up with the state. There's just a lot more to it. So the barrier to entry is just higher with a private foundation. Let's move on to the next slide. I think I mentioned before, administration costs. The only thing a donor advised fund really pays is general, just some investment management fees. There's a lot more fees with a private foundation. Again, donor advised funds, you have a lot of room for confidentiality and privacy. You can usually make anonymous donations through a donor advised fund. Private foundations, they're called private foundations. They're anything but private. They're kind of the opposite. The records are very public. You have to file a tax return each year, and those tax returns are open to public inspection. Anybody with an internet connection can look over the tax return for your private foundation, look at what your investments were, look at where you gave money. So there's not a lot of privacy with a private foundation. That's something that sometimes spurs people towards the donor advised funds. I think I mentioned earlier, private foundations, you do have a lot more control than you do with a donor advised fund. And the AGI limits are a little bit lower for a private foundation. If you're going to give cash gifts, your AGI limit for a donor advised fund is 60%. If you're going to do a private foundation, it's 30%. If you're looking at appreciated stock, say, for a donor advised fund, your AGI limit would be 30%. For a private foundation, it would be 20%. So if you're worried about your AGI limits, they are going to be lower for a private foundation. Next slide. Okay. These are some kind of more advanced topics. The vehicles we're going to talk about are a little more complex. Any one of these, we could spend an hour or two probably talking about each one. I'm just going to touch on these and kind of make sure you understand that they exist and kind of the basic, what they are. If you think you might be interested in learning more about any of these, if you think they might be a good fit for you, please feel free to contact any of us at any time. We'd be happy to sit down and talk to you about these and about the more specifics of how they work. But in the interest of time, I'm just going to kind of go through these quickly. A charitable gift annuity it's really just a contract between yourself and a nonprofit, a charity that you want to support. It's not a separate like legal entity. It's not going to file a tax return. It's just a contract, an agreement. And usually these are with a larger nonprofit, like a university, a hospital, something that's large enough that has like a plan giving office. So the way these work, you make a gift to this large nonprofit, you get a deduction, a partial deduction for that amount, which we'll talk about. So they get some cash from you, and then they turn around and agree to pay you a fixed stream of income for the rest of your life. That's the annuity. The amount of payments that they're going to give you, of course, they're going to be based on your age. There's a whole calculation that goes into that, but it's your age and your life expectancy. If you're younger, you're going to get smaller payments, but the idea is that you're going to live longer and get more of those smaller payments, hopefully. The deduction you get, it's a calculated amount. It's going to be based on the estimated amount that the charity is going to end up with after all the payments are made. So again, it's based on your age and life expectancy. But the rate, the discount rate they're using, the amount of the payments, the timing, the frequency of the payments, whether they're annual or monthly or whatever, all that's locked in and put in that contract. It's not negotiable. There's not going to be like an inflation adjustment if you decide you need higher amounts. If this is, if you're supporting your lifestyle on these payments, you're locked into the amounts. You can't renegotiate them later. And keep in mind, those annuity payments that you get, a portion of those is going to be taxable as you get them. Charitable lead trusts and charitable remainder trusts, just like they sound, those are both types of irrevocable trusts. So both of these are entities that would file their own tax return, have their own tax ID, whatever. And they're kind of the opposite of each other. They're both trusts, and you would fund them with initial gift. The reason I say they're opposites, a charitable lead trust, once you fund the principal of that, you're going to have a designated amount of time, whether it's a spelled out, 20 years, 30 years, or whether it's tied to the life of a person, a designated person until they die. But for whatever that designated amount of time, they're going to pay out an income stream out of that principal to the nonprofit or nonprofits multiple that you designate. And then when that time period ends, the remaining principal in there comes back to your family, your kids, your heir, whoever you designate. The opposite of that, the charitable remainder trust, you still fund it, and then the income stream gets paid to you or your family or whoever you designate, and the remainder at the end goes to the charity. So the charitable lead trust, the nonprofit gets money first. The charitable remainder trust, the nonprofit gets the money at the end. So like I said, kind of opposites. There's a lot of complexities with all three of these vehicles, but they're all three popular estate or charitable planning tools and estate planning tools. We'd be happy to talk to any of you about these if you're interested and want more information. But at this time, I'm going to turn things over to Jeff Silver.
All right, thanks, Rebecca. Good afternoon. My topic today is on the tax credits that were either extended or tweaked a little bit as a result of the Inflation Reduction Act. So the first slide here, the IRA, as it's known, was signed into law this summer in August, and it created over $400 billion in new spending and tax incentives. And the primary goal was to boost clean energy by lowering carbon emissions and things of that nature, also reduce healthcare costs and funding for the IRS. My presentation today will be focusing really on the tax credits for clean energy products. Next slide, please. The tax credits are primarily for, again, for clean energy production and investments in wind, solar, and geothermal energies. The tax credits are for electric vehicles, as well as residential clean energy projects. The one a hot topic is for electric vehicles. It was always there. There was caps on certain number of production of vehicles. But what's new in this IRA is that used electric vehicles are also now available for a credit of over about $4,000. Next slide, please. So clean vehicle credits. So again, the electric vehicle credits have been around for a while. They've been extended for many years through 2032, but they've changed a little bit. What they've done is for electric vehicle credits going forward, the manufacturing, the end final assembly of the manufactured electric vehicles must be done in North America. That requirement was not there before, but that's new, effective in August, that the vehicles need to have the final assembly in North America. But again, the credit's been extended through 2032. And what it also does, the IRA also does, is it removes the manufacturer sales caps. So there were $200,000 sales caps in many of the vehicles, which is no longer going to be the case going forward, effective January 1st, 2023. So that should increase the amount of electric vehicles that are available for the credit. Starting in 2024, and this is interesting, instead of the credit being taken on your tax return, you will be able to transfer the credit to the dealer when you buy the vehicle, so that instead of buying the vehicle, getting the credit on your tax return, you can effectively reduce the price of the vehicle by the available credit. And so that starts in 2024. Again, that's new with the IRA. That's going to become probably very used in the future as a result of not having to wait for the credit later. You can use it as a reduction in the cost. Next slide, please. And in order to determine whether the vehicle has its final assembly in the United States, it's actually the same website, but you can look at this website to see if it qualifies. I'm assuming the manufacturers are going to know, but here's a way to find out based on the government regulations. Next slide, please. So what's the tax credit and what do you get? For new electric vehicles, for clean vehicles under 14,000 pounds, you can get $7,500. That's basically passenger vehicles. But for larger vehicles, such as fire engines, for example, or buses or things like that, that have gross weight over 14,000 pounds, the credit can be up to $40,000. And again, for the used electric vehicles, the credit can be up to $4,000. And the formula there is the lesser of 30% of the price of the vehicle, or 4,000, whichever is lower. Again, the two new areas really are in the credit part, is the credit for the larger vehicles over 14,000 pounds and the availability of the used electric vehicle credit, which didn't exist before. Next slide, please. Okay, so in doing so, in giving the credit, what the Congress did was they lowered the availability of the price of the vehicle, so that the passenger vehicles, I'm calling them passenger vehicles, can no longer, I'm sorry, these are the larger vehicles, can no longer be more than $80,000. For regular passenger cars, it's $55,000. And then for previously owned cars, it's $25,000. They lowered these caps to I guess, exclude some of the more luxury version of the electric vehicles. There's also imposed a availability of the credit goes away once you have adjusted gross income over certain thresholds, and they're listed here. They're relatively, low, and is again is preventing the more wealthy people from getting the credit. So these are new and they're effective in 2023. Next slide, please. So moving on to home energy improvements. And so what used to be a $500 lifetime limit on certain credits is now replaced with an annual limit of $1,200. So that significantly increased the amount of the credit that's available on the non-business energy property credit. And so it's basically 30% of the cost of the home improvement, with a cap of $1,200 for the limit. And there's different categories of available items that will give you different amounts of credits, like windows, for example, doors, things of that nature, all have different amounts that are available to you. But again, they've increased the amount of the credit to be annually $1,200 as opposed to total lifetime of $400. So that's going to really change, I believe, the amount of renovations that are being done in order to get the credits. There are also certain criteria that need to be available in order for the products to be eligible for the credit. And they're more strict now than they were before. Again, I believe the manufacturer will most likely have that information, but just beware of that restriction going forward. Next slide, please. There's also the residential energy efficiency credit, which was set to expire at the end of next year, but is extended through 2034. The amount of the credit is the same. It's 30% of the cost of the item, but in 2033 and 2034, the credit is down from 30% to 26%, and you'll see 22% for 2034. And basically, this is for solar paneling and geothermal heating and things of that nature that are more significant investments in your property. And it's a huge credit, and it's been extended. So I think that's really good and another incentive to continue with clean air projects. Next slide, please. So what's also new with the IRA is the availability to either use the credit as part of your purchase price or transfer it to somebody else for its use. Why would you want to do, well, the direct pay, of course, you would want to use it as a reduction of your sale price, but why would you want to transfer your credits? Well, certain nonprofits that are investing in clean energy projects, who would be eligible for the credit don't really need the credit because they don't pay tax. So going forward, that credit will be available to be transferred to allow for an individual or for businesses to reduce their tax liability. And so this will be starting in 2023. And the eligible credits are listed on the bottom here. It's for the renewable electric production credits, clean hydrogen production, qualified commercial vehicles was what we talked about before, with the buses and the fire trucks and things of that nature. And so I think this is going to be another way to increase the incentives for businesses, including nonprofits, to invest in clean energy projects. And so with that, I want to introduce again Carrie, who will be doing the Pennsylvania update for activities this year and beyond.
Okay, so what's new for state and local taxes? I'm going to blow through this since we only have a couple minutes left, and I apologize if we don't get to talk about everything. The corporate net income tax rate for Pennsylvania is going to be reduced. There's a 1% drop starting January 2023, and then annual reductions until it reaches a bottom rate of 4.99% in 2031. Pennsylvania will now also conform to IRS Code Section 179, expense deductions and 1031 like-kind exchanges. Previously, PA did not conform. There was a $25,000 cap for 179 and 1031 exchanges were disallowed. Economic nexus, Pennsylvania officially implemented a $500,000 threshold for corporate net income purposes. And this means that out-of-state businesses that have income in Pennsylvania, sourced to Pennsylvania of $500,000 or more may have a tax filing requirement. Market-based sourcing, I think I'm going to pass on that and move on to the bigger one, or maybe that more closely impacts many people. Pennsylvania for the first time created a refundable child care tax credit. The credit is equal to 30% of the federal credit. As well, similar to what Jeff was talking about, multiple PA credit and incentive programs as well have been increased or made more accessible within the state of Pennsylvania. One downside is that the General Assembly did not include an elective pass-through entity tax, which I unfortunately would love to talk more about, but if you have questions on that, please feel free to contact us. Next slide, please. On the other front, another front, Pennsylvania is rolling out its new online system called MyPath. This will offer lots of improvements for for businesses and individuals. You do not need an account to do many things, but if you do create an account, you can do things like track your refund, and you can confirm successful filing. You can view detailed statements of accounts. Businesses will be able to do business registration and track payments and credits, as well as request refunds. Next slide, please. Philadelphia is also having some good changes. They reduced the business income receipts tax, the net profit tax, the wage tax, and the school income tax rates. The city also increased the homestead exemption to a maximum of $80,000. This reduces the assessed value of on which a home is taxed, and this increase could reduce the property tax bill by up to $1,119. Let's see. Philadelphia is also moving towards market-based sourcing, similar to Pennsylvania. If you have questions on that, be delighted to discuss it. Please give us a call. And last slide, please. Philadelphia is also working on a new website. They've been changing over. You're going to have to pay some taxes like property, wage, UNO taxes on the website. They also rolled out a new account number called the PHTIN for a couple of great reasons. And the last important thing to note about the website is that if you want to switch over previous accounts to the new website, you'll want to make sure to do that early, because the verification process includes sending you a physical letter in the mail. So please make sure to start that with plenty of time ahead. Thank you.
All right, thank you, Carrie, Mitch, Jeff, and Rebecca for everything. And we're running up against time, so we don't have any time to answer questions. So those of you who did leave questions, please make sure that you added your email address so that we can get back to you afterwards. And we will be happy to respond to that or any other questions that may have come up. Otherwise, thank you again for attending, and we'll see you next time.